Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
So greetings, everyone. Happy New Year. It's January the 7th, Tuesday. Thank you for the Foundation's presence in our lives. If it weren't for the Foundation, I would be a lot less rich. And I say that very pragmatically because I believe that cycles and seasonals should be used to the advantage of the individual investor and or the trader, or for the good of humankind. So if you find that my comments here are a little mercenary, so be it. Just go with the flow. I want to thank everyone who sent me some wonderful letters, especially in the last few weeks. I appreciate that, and I hope to continue to present here. I think we're going to do this twice a month, not sure, but in any event, rest assured that I'll give you my best shot. So, as I've said many times, I consider a cycle to be a pattern. And by the way, pardon the voice, it'll be fixed by the end of January. I consider cycles to be a pattern, and there are many different patterns. I'm going to share two interesting patterns with you today, and I'm going to be very specific about those patterns, where to buy, where to sell, whether to buy or not, and so forth. And it's all based on specific research. I covered this in my annual forecast. I'm going to use a PowerPoint presentation from that webinar in order to give you specifics and not have to do this over again. So these are some of the issues that I covered in that webinar. This is not an advertising for that webinar. So let's do this. First, the usual disclaimer, which is right over here. You can lose money trading and so forth, blah, blah, blah. I want to do a little comparison that you might find interesting. Last year, in my annual forecast, in other words, in 2022, I gave this forecast for 2024, sorry about that. So at the end of 2023, I gave this chart, which is a seasonal chart you'll recognize because we've used it before, and it gives you specific details on the normalized data. In other words, we took every year in S&P and we converted it to an index, making the low of each year 0, the high of each year 100, so that no particular 1 year or 2 years or 3 years were influencing this market DNA. In other words, this shows what I believe to be the underlying trend in the S&P over the course of many, many years. Using this chart, I predicted what would likely happen in terms of the trend in 2024. So the upper chart shows what was predicted. The lower chart shows what actually happened. Look at the two. I find the interesting fact about all of this that not only did it find the peaks and the valleys very accurately, but also define the trend. Not perfect, but certainly very easy to do, based on history, no interpretation, no analysis, no Fibonacci numbers, none of that stuff, just the raw data. Isn't it interesting that we generate this chart right over here without this data and then show this data independent of all of this right here? I take that to be a strong testimonial, in favor of seasonality, something that you'd want to take care of and look at very clearly. In the next session that we do, I will show the prediction for 2025, and then at the end of 2025, provided we're still here and viable, we'll take a look at it and see how do they compare. I think it's very fascinating. But I have something more interesting for you. Many traders have talked about the decennial pattern, the 10-year cycle, the presidential cycle, what happens to the market after a new president takes office, what happens to the market in January, February, March, and so forth. And many of the traders have talked about something called the January barometer. Be careful what you believe. Be careful what you tell yourself, because you may start believing it. The January barometer is not a barometer because it does not contain the necessary elements to be a barometer. It simply says, as January goes, so does the market. That is not specific enough for me. I want specifics. So what I did was very simple. I use the power of artificial intelligence. The question is very simple. It was based on the idea that January is important and the years numbered 5 are important. In other words, 1975, 1985, 1995. Most traders believe that years ending in 5 have been bullish years. That's only part of the story. I want to be more specific. So when I do my work, I do setup, trigger, follow through. The setup in this case would be the assumption that January is important and the assumption that the years numbered 5 are important. So how do you put these two together? So I went to chatbot, GPT, and I said, have years ending in the number 5 that close above the January high been bullish years? Very simple question, something that's certainly within the capability of artificial intelligence. It's even within the capability of actual intelligence, of which there is very little these days. However, computer says, yes, years ending in 5 that close above the January high have generally been considered bullish. So what does that mean? Behaviorally, it means at the end of January, we take a look at the high and the low, and if we close above the January high at any point thereafter, that would predict a bullish outcome for the year. As far as I'm concerned, it needs more than that, but let's see what happens. So I asked the computer, what has been the percentage accuracy of that? Of what? What has been the percentage accuracy of the market remaining in a bullish mode for the rest of the year if it closes above the January high? Now we have a setup and we have a trigger. The setup is the January ending in 5, and years ending 5, and the trigger is closing above the January high. Computer says the predicted accuracy of that pattern has varied, but has been around 70 to 80%. Well, if you ask any trader who's been around for a while, if they can achieve 70 to 80% accuracy, they would be thrilled to do that. So here we have a basic pattern that's been correct a high percentage of the time. How do we use it? Is it a cycle? I believe it's a cycle within the broad definition of a cycle that I use. In other words, it's a pattern. So, of course, observing proper decorum, I thanked Anna because I don't want her to get mad at me. And then we did some research. Let me show you what I'm talking about. So here is the chart. Year ending in 5, 2005. These bars are monthly high, low, open, close for the entire month. So this would be the January open, high, low, close, February, March, April, May, June, etc. You get the picture. It's not rocket science. So I'm looking for a closing above the January high. This is the January high, the red line. And at no time for the rest of the year did we close above the January high. We penetrated it briefly, but we did not close above it. So you say, well, we closed below it. Is that a sell? The answer is no, because this is a buy pattern only. This does not work for sell. Therefore, in 2005, based on this concept, setup and trigger, there was no trade. No problem. Let's go to another year, ending in 5. And remember, this is specific only to years ending in 5. It does not have anything to do with economics, with politics, with geopolitics, or anything like that. Earnings reports or anything. It's just a simple pattern which we have defined operationally as years ending in 5, the penetration of the January high, and get this. The January high must have been penetrated on a closing basis 2 consecutive times. Let's see what that means. Let's take a look at this chart. 2015. Number 1, does it meet the requirement for a year ending in 5? The answer is yes. Number 2, did it end any month thereafter with 2 consecutive closes above the January high? So here is the first close above the January high, but there was no second close above the January high. Here's another one here, but no close above the January high for a second time. Therefore, this year did not trigger that signal. I want to make sure that everyone understands this, so we're going to do this again in another year numbered 5. This is the year number 1995. So let's take a look, because here is your classic example, your paradigm, your model for this particular pattern. And the good thing about this is, hopefully, We will still all be here at the end of 2025 to see how it turned out. In fact, you will notice a further pattern in the data. Pattern number one, it usually triggers within the first 6 months of the year. Pattern number two, once it triggers, the year usually continues higher and ends toward the high of the year. So this is the model, the paradigm for that year, 1995. Now you may be tempted to ask the question, what was happening in 1995? What was the political outlook? What was the economic outlook? What was the geopolitical outlook? I don't care. All I care about is the pattern. So let's talk about the pattern. January ends, high and low. Here's the January high, right over here. And then February and March, 2 consecutive months in which we closed above the January high. A beautiful example of the trigger. What would most traders or investors be thinking? They would be thinking retrograde. They would be thinking, well, it's too high right now. What does that mean? How do they know it's too high? What does too high mean? There is no such thing as far as I'm concerned. They would be thinking, I knew this was going to happen. I should have bought it over here. I should have bought it over here. There is no should have as far as I'm concerned. The fact of the matter is, this is a trigger. And the trigger says, buy right away. Use what I call a GMI order. Jokingly, get me in. Or an LMI order, which means let me in. But no, most people will say, I'm going to wait for a pullback. Sometimes the wish for that pullback will come true. Most of the time it won't. And you can see what happened. The buy trigger was here. This was the setup right over here. And you followed through to the end of the year and ended the year almost on the high of the year. Clearly, the specific pattern we talked about. Year ending in 5, 2 consecutive closes above the January high, follows through to the end of the year. There's only one thing that's missing now. Actually, two things. Number one, the stop loss. Number two, the profit target. The profit target is easily figured out, and I will show that at the next session. Today, I just want to have enough time to get through the basic pattern because we are going to look at all the years numbered 5 all the way back to 1900. Boy, oh boy, that's going to be fun, isn't it? Let's take a look at the next one. 1985. So what happened in 1985? Very simple. We established the January high right over here. And then, after playing around with us for a few months, we got our first close above the January high, second close above the January high, and we were off to the races, had a little bit of a pullback, and then ended the year on the other pattern, which is the high of the year. So we've seen that established a number of times. Now, statistically, it would be good if we had 100 years of data, but 100 instances of the years numbered 5, but we don't. We're using all the data we have, and so we have to do the best we can and watch for this pattern. Let's go to the next year. This was 1985, so here's 1975. Now you're going to say, of course, it's a decennial pattern. Whatever you want to call that pattern, it is what it is. It's either going to work or it's not going to work. It's either going to trigger or it's not going to trigger. It's a cyclical pattern. It's a cyclical seasonal pattern because we're using the months of the year in order to establish our entry or our exit. So let's take a look. 1975. And by the way, why am I using the Dow Jones? I'm using the Dow Jones because it's the longest continuous data set that we have. Some of the others don't go back as far, so we can use the S&P if we want to get a full picture of as much history as we can. And remember, as cyclical traders, we try to get as much data as we can, not as little data as we can, because if we get more data, we have more statistical reliability. And admittedly, certainly this particular pattern lacks statistical reliability as much as it should because the data set is limited, but we do the best we can. So here we go, 1975. Bingo and bingo. You're off to the races. And once you see the pattern, you're buying at the market. Now, certainly we didn't end the year at the high, but we recovered a little bit from the previous sell-off. We certainly did make money on this trade because this is where the entry was right over here. So that was 1975. By the way, if any of you have questions about this pattern, you can certainly research it yourself. The data is out there, but I'm happy to take your questions by email. Let's go to 1965. So what happens in 65? We established the high of the month right over here. And we have our two consecutive closes above the high right over here. For those of you who are waiting for pullback, your wish came true all the way down here. So what would be the stop loss here? Closing below the January low would be the risk. You can see that did not happen. We came close, but we did not close below it. We penetrated it, but did not close below it. And that's very important. Excuse me. So then what happens? We go on through the rest of the year. We close the year very strong. In fact, we end the year on the high after a little bit of heart failure here. But again, it's all about being systematic. So when you got into this trade, you knew what the risk would be. If you didn't like that, you could certainly have done this with a long-dated option and so forth. But I'm not going to talk specifics about that. I'm just going to show you the pattern and let you be the judge. That was 1965. So let's go back in time to 1955. So this is 1955. There's your January high right over here. And here's your two consecutive closes above the January high. And here's your follow through to the end of the year. Now, maybe I'm just hallucinating, but many of these charts are starting to look the same. Isn't it interesting how similar the years are, even though the geopolitics have been significantly different? Remember that since the early 1900s, we've had the Great Depression, oil run on the banks, we've had OPEC, we've had Middle East war, we've had Democrats for presidents, Republicans presidents for presidents, morons for presidents, and none of these seem to have made any difference in terms of this particular pattern. It's possible that there's a further correlation going on. We can ask AI to find it for us. But right now, I'm happy with what we did discover, and we certainly intending on using it. So let's go to 1955, and we see the pattern there. Let's go to 1945. The world coming out of the war, and people would say, well, the war was a significant event, and therefore this pattern won't be repeated. So let's take a look. Here it is, 1945. There's the January high. There's the January low right over here. There's one from the month close above the January high, but it did not happen until here. You had two consecutive closes above the January high. Your wish for a pullback came through, and here we go to the end of the year. And that year-end strong pattern is very significant and keeps repeating. Let's go to the next one. 1935. People would say, 1935, whoa, there's a lot of bad stuff going on in the world, a lot of geopolitics, watch out what happens. So here it is. Close number one, close number two. So there's the trigger and follow through to the upside to the end of the year. 30% gain. Let's go back to the next year, to the previous year, 1925. Here we go. So what happened in 25? In 25, we had our two consecutive monthly closes above the January high right over here. And bingo, there's your buy trigger, and follow through to the end of the year very strongly. So let's review what we see. Years numbered ending in 5. Number 2, two consecutive monthly closes above the January high. Number 3, it's a buy pattern. Number 4, your risk is a close below the January low. So please let me point this out to you, very important. We did close below the January low, but the trigger had not happened yet, so therefore we couldn't be stopped out of a position because we had no position until here. Let's go to the previous one, 1915. Here's 1915. And what do we see? Well, a whopping gain of 38% through the end of the year. I put this in incorrectly. This should end right over here. So there's our two consecutive closes above the January high. And I want to reiterate something super important. Remember, most traders and most investors are looking to get a bargain. They're not looking to buy on strength, even though we know statistically and behaviorally, the fact is buying on strength is much higher accuracy than buying on a pullback. When you buy on strength, you're getting on a train that's moving in the right direction. When you're buying on weakness, you're getting in a train that's going back into the station. You don't want to buy into that because you're generally catching a falling knife. So buying on strength is a good strategy. So that's 1915. I'm not sure if I have 1905. Let's take a look. Just a moment, please. There is 1905. And here's your two consecutive closes above the January high. Here's the pullback you've been waiting for. Although remember, you're buying on strength, so you would be technically long right over here. Your stop would be closing a month below this low right over here. And there's that pattern again, follow through to the end of the year in strength. So there you have it. Years ending in 5, setup, trigger, two consecutive monthly closes above the January high, follow through to the end of the year. Stop loss is a closing below the January low. That's all there is to it. If there's any questions, I'm glad to answer them. Let me show you one more thing. So now let me share one more thing with you. We know from considerable research that January has been a very important month, as I just showed you. We also know that October has been a very important month for stocks. Stocks usually making their lows on or about the 26th of October. Doing a search of the database, I found this. Very, very simple and very, very specific. In doing seasonality, doing a search, answering the question, are there any patterns in the stock market that begin in October and end in January that have high probability of success? Doing the search, here's what I found. In S&P futures, buying end of day, October 26th, getting out end of day, January 16th. Over the course of many years since 1960 has been accurate 85% of the time. Certainly a trade that defies all logic in terms of fundamentals, because since 1960, we've had all sorts of geopolitical fundamentals, which should have affected prices, but in fact, they have not, because an 85% probability is quite impressive, particularly over the course of time. So this qualifies for a very valid seasonal cycle. Let's take a look and see what the statistics are here. You notice the average profit during this period of time has been around 6.37%. We've had 18 maximum consecutive winners and so forth for all of the various statistics. The question is, number one, did we know this before it happened? The answer is yes. Number two, did it work? We were about to find that out. But I want to point something out to you that's super important. We know that 90% of traders or more lose most of their money in their accounts within the course of 5 years. We know that most traders are losing traders because number one, they don't have the discipline. Number two, they don't have the rules. Number three, they don't have the specific amount of information they need to make trades that have exact entries and exits. So this is a true pleasure to have this information beforehand. And that's just the beginning. The question is, what happened this year that just ended? In other words, this research that we're showing right over here did not take into consideration anything that's happened this year. This is all historical stuff. Let's take a look and see what happened. The next slide shows a chart. If I can get that chart. Let me get my mouse back. The next slide shows what actually happened. So here it is. The entry date for this trade is right over here. And you'll notice what happened. Shortly after entering the trade, for the next several days, Jake is a bum because the market goes against us to the tune of $740 on the S&P, on the Dow Jones, 140 points, 740 points, or 74 points, I'm not sure. But either way, the risk on this trade, and let me get my pointer back just 1 moment, please. The risk on this trade was 12%. At its worst, it went against us by 1.75%, only to turn around a few days later and score this beautiful gain of over 6%, approaching the profit target over the course of the next several months. That was the Dow Jones. The same date combination in S&P. Let me get that for you. Just 1 moment, please. Here we go. Here's the Dow again, as of just a few days ago, now reaching a gain of 6.34%, all based on the same concept we did before, a seasonal search. Here's the S&P situation. Here was the entry date on the S&P right over here. Let me get my pointer back. Just 1 moment, please. Here we go. So entry date right over here. It went against us by 2.34%, which is not very much these days, and certainly followed through very nicely for a 4.26% gain. So let me review what we've done today. Number one, we looked at the Dow Jones January high and low in years numbered 5 and generated a specific trigger for this cyclical pattern. Number two, we looked at the best S&P trade in the course of many years, getting in on October the 26th, getting out on January the 16th, with specific accuracy of 85% or more. If you like this kind of information, please let me know and I'll show you some more next session. In the meantime, I want to wish everyone a Happy New Year, best of trading and best of health. And if you have specific questions, please don't hesitate to send them to the foundation. I will answer them as best as I can. Thank you.